Okay, and we are live on Facebook. Hello, everyone out there. Thank you for joining us. I'm Andrew Berman from National Mortgage Professional Magazine and Mortgage News Network. Thank you so much for joining us for another episode of the Mortgage Leadership Outlook series. Today, joining us, I've got my good buddy, Peter Norden. Peter Norden, if you don't know him already, he's the CEO of HomeBridge Financial Services. You know what I've always referred to Peter as someone who trades MBSs for sport. I think he loves this stuff. I mean, besides being we were going over this. I think was it 43 years in mortgage banking, Peter?
Yep, 43 years.
43 years in mortgage banking. He's 43 years in mortgage banking. Obviously you probably know him through HomeBridge, Remen, and just a history of just some great actually brands in the mortgage business. We've seen some wild times, but obviously nothing like what we're seeing here today. So Peter, let's start off like with your stress level, because before we got started here, I hope you don't mind me revealing this. Peter just relieved a little bit of stress playing a little bit of Cat Stevens. It was just awesome. I'm sorry, no one is going to be able to hear. I got a private showing. Just a little moment to brag there. Peter, thank you for that. I appreciate that.
That is too funny. Andrew, that's really funny. So the truth of the matter is, Andrew saw my guitar in the background, which every once in a while I do use as a stress release. And, he sort of talked me into, why don't you pick it up for a minute? So I said, I'll do it offline. I will not do it online. So yes, he got a song out of me. So it was actually pretty funny. It was pretty funny.
It's good.
It was a good stress release for me before we start this. Yeah, no question.
So how is your stress level today, specifically today? And then I want you to tell us the timeline that led up to today. But how's your stress level today?
It's a good question. My stress level today is actually much better than it was at the beginning of the week, and certainly better than it was last week. So, it varies. It goes up and down accordingly, because we have certainly gone through a major roller coaster.
Yeah.
Unfortunately, you did reveal that I've been in this business for 43 years, which is sort of sad to me, but, I've been doing this a long time. I've been through every cycle you can possibly think of. I will honestly tell you, though, this cycle ranks up there as one of the worst, without a doubt, because of the different stresses on different sides and for different reasons than what we historically have gone through. I mean, certainly 07, 08 was a horrible time for anybody in the mortgage business. This, though, has a different feel to it. Number one, it's not caused by the banks or the mortgage business, the economic downturn. This is caused by a virus, which is something certainly none of us have ever gone through. I'm not that old. I wasn't around in 1918 for the last one. So it has really, it's definitely been a difficult time for anybody that is in the mortgage business. And just to give you a little barometer from a timeline perspective, I looked at the chart of Fannie Mae threes before I got on here. And as Andrew said, I used to trade mortgage backs pretty heavily for a long part of my career. I no longer do the trading, but I am heavily involved with my capital markets group. And Jeff Panther, who's my lead trader, who I think a lot of people on this know. And we talk probably 10 times a day. And I asked Jeff for where were the Fannie threes at specific dates. So to give you a little bit of an idea of where we were, on February 3rd, Fannie threes were trading at about 102. By the 28th of February, which is not all that much volatility, they were trading at 103. But here's where it gets really volatile, between February 28th and March 19th, and certainly today. So February 28th, Fannie threes were trading at 103. By March 19th, Fannie threes were trading at par. So they had tanked, totally and completely tanked. So obviously in February 28th, rates were down. Business was doing fine. Business was, humming along. By March 19th, when the virus really started to hit, which was really that week, you literally had a shutdown of any desire on the part of any investor to buy a mortgage-backed security. So basically, the market tanked 3 points extremely quickly. I'm heavily involved at the MBA national level. I am on the board of the MBA. And basically, I clamored to the MBA, as did a lot of other CEOs in the business, clamored that we've got to get the Fed to do something here and back us. And when the stimulus package came out, which was $2 trillion, which is something we'll talk about in a few minutes, when the stimulus package actually came out, it was very obvious that the Fed had to do something to support the markets before the markets totally and completely collapsed, which is really what it looked like was happening on March 19th, right around that period of time. So we did, the MBA went to the Fed specifically and Treasury and said there has to be some support with the stimulus package. That did happen. The support came. And then all of a sudden we started to see a dramatic rise in mortgage-backed securities. So you went from March 19th with a Fannie 3 being at par, you went on March 30th to Fannie 3s being 105.5. So between that period of time, on March 19th and March 30th, every independent mortgage banker, every bank, every credit union that uses mortgage-backed securities to hedge literally got margin calls on their positions that they added to the tune of 5.5 points between March 19th and March 30th. So everyone got squeezed for massive margin calls. Today, the Fannie 3 is trading around 105, about 0.5 point lower than where it was. So we have gotten some margin money back this week, but the margin calls for the industry were clearly astronomical. There isn't a company out there that avoided it unless they were totally and completely long their pipeline. So relative to that, I just want to give you a timeline on the 10-year. So the 10-year, which mortgages normally trade off of the 10-year, has been somewhat as volatile, but not as volatile as mortgage backs. There's always been a correlation between the 10-year Treasury and mortgage-backed securities. This time around, the correlation broke apart. For the first time I've ever really seen it where it dramatically broke apart. To give you an idea, so the 10-year Treasury at 12/31 was 192. On February 3rd, it was 150. On February 28th, it was 110. On March 9th, it closed at 42 basis points and was as low as 31 basis points. And then ticked back up on March 30th to 68 basis points. And today, the last time I saw, it was trading around 62 basis points. So this is one of the few times you've actually seen more volatility in mortgage-backed securities than you actually have in the 10-year. The 10-year has pretty much just gone straight down. I mean, there was one blip in there around March 9th where it actually did tick up. But for the most part, it really diverged from that correlation, which for anyone who is hedging servicing portfolios, most people always use the 10-year to hedge their servicing portfolio. They got crushed during this as well because it worked as far as the 10-year going down. But when the 10-year blipped up, as well as, and the treasuries and the mortgage backs went the other way, people got caught in the hedge as well during this period of time. So, you know, mortgage bankers certainly are under strain. Plus the fact, obviously, we're dealing with volume constraints. We're inundated with volume. Everybody wants to refinance. I think everyone is seeing that. Our volumes are incredible. I will say at HomeBridge and Redmond Wholesale, because I don't want to forget them in here too as well. Between the entities, which are obviously together, we ended up closing in March $1.9 billion in loans while everybody's working from home virtually everyone's working from home. We do have some associates that are working in offices where they feel they have to, and it is really essential workers. So we do have some of that. But the fact that we closed $1.9 billion in this marketplace with what's going on and with the restrictions that everybody has all over the country, I think is just incredible for everybody involved in the company. And I assume other people feel the same way.
So, I mean, but put this into perspective. What was March 2019? If you know the numbers offhand, just a roundabout figure of where March 2019 volume was.
At March 2019, I believe we were about $1.2 billion. So we're 700 million higher for March of this year. And we anticipate right now that April and May will be upwards of 2.2 billion per month, maybe as high as 2.4 billion, which is a major strain. I'm not going to say it isn't. I mean, it's not easy to handle. There's no question it's not easy to handle.
Okay.
But we're with, our back office has just been phenomenal in getting loans out and getting them out quickly. So it's been great.
I mean, most of your workers were not remote workers. Most of your workers, showed up to an office every day. What did that transition look like, and how's productivity looking like for the organization overall today?
The transition, frankly, one of my partners, Joe Sheridan, actually handled it, who's our chief operating officer. He really handled a lot of this, the transition to the work from home status, as well as certainly our IT department as well. And they've done a pretty seamless job getting it so that everybody can work from home and can do what we have to do. The VPN seems to be up and running fine. From a productivity point of view, I'm sort of shocked, and I've said this to my own people on the phone just as recently as this morning. Our productivity in getting loans through the system and getting them out and delivered in security form or delivered to Fannie Mae or Freddie Mac has just been extraordinary. I actually think that everybody's so bored and tired of being home alone that they'd rather sit and they're working a lot harder and much more dedicated to what's going on a day-to-day basis from a work perspective, because the diversion, since we can't go out shopping, we can't go to the movies, we can't go play golf, we can't do all the things that we really like to do when we're home, it's actually increased the productivity dramatically for everyone. So, I mean, I can't tell you how proud I am of everybody in our company as the way this has come together as a team. And I gotta believe this is going on everywhere. It's not just us. And we all think our employees are the best and our associates are the best. We all feel that way. I don't think there's any question. But, this is a time where we've been a pretty divided country. And if anything, I think this virus is actually bringing us together and uniting us even more than before. And everybody's determined to make sure that we get everything done and make sure that our customers, both on the retail side and the wholesale side, are taken care of. And I think that's really, it's one of the most beautiful things I've seen here, how everybody is pulling together.
Yeah. Would have thought social distancing would have brought us all closer together.
Yeah, exactly. I think that's really true. It really has. No question about it. So.
Yeah, and we have Iris Hale, a HomeBridge employee, bragging here, saying transition was seamless. So yeah, I guess that's echoing throughout the organization. So
I don't take any credit for that. That I don't take credit for. I give the credit to everybody inside that worked on that, and Joe and our IT team and everybody there involved, frankly.
That's great. That's great to hear. So got a question that just popped up from Melissa. Do you see the industry moving towards a remote setting moving forward? Specific to your organization, have you guys had talks and saying, hey, listen, do we really need to have as much physical space, or can we allow the workers who are having that high level of productivity work from home? Or do you think this could be just a short-lived, boost just because of, we're
Right.
on lockdown?
Um, I can tell you from our perspective, we have already talked about it at the senior executive level as to how much office space do we really need if in fact our productivity can be as good and maybe better from working from home. And I will also say that myself and my partners all have always been against working from home.
Yeah.
It is not something that we've ever agreed with. Some of it's our age. It's age related and we're just not used to it. I think work from home can really work as long as you have productivity standards and you can measure those productivity standards. So I think that I always felt that that could work really well. So I think we all have to develop better productivity standards. I think we've done a good job with it, but not a great job. But I think in this time specifically, it's accelerated our productivity because of the desire for everybody to perform, and really everybody wants to be together, even though we are apart. So, the other thing that always worried me with work from home is how do you really get a team spirit? And how do you really get that team feel? Because all the companies that I've had in my career were always about teamwork and always about being a family. And I have always, and my partners, we always treat everybody that works with us. Number one, we view them as working with us, not for us.
Mm-hmm.
And that's the truth. And everybody knows that's how we feel. So with everybody that works with us, we want them to feel like they're part of a family. When you're working from home, that's not that easy. But one thing I'm learning as as I'm going through this myself and I'm in my own isolation, I'm really learning that through videos and through social networking, and I'm somewhat limited as how much social networking I will do. But, I've started doing videos to the entire associate base so that they know I'm out there, that they know I'm thinking of them. I'm going to do them more regularly. It's not that easy for me to do this. I'm not used to it, but I actually think that there really is some real value in it. And maybe we can actually treat it more like a team if we can do more of this and let people work more from home. So as far as the space issue is concerned, I think we are starting to look already like how much space do we really need? And can we really cut back our cost to produce alone by cutting back on all the space we have? Yeah, and it is something we've been working on for the last 6 months anyway, in shutting down offices that aren't productive or where people really are working from home and they're not in the office. There's no reason to renew a lease in that circumstance. So yes, we are looking at all of it. Yeah. And looking at it heavily for the future once we get back to normal, which hopefully is soon.
Yeah, well, and a lot of these new habits that we're creating are going to create this new normal of a lot more remote working. And listen, I'm talking to a lot of people that are basically they're sitting in their homes, they're looking at their kitchen that they were happy with, that they're not as happy with anymore because they're spending so much time in it. They're saying, hey, maybe we should look at actually redoing our kitchen. I'm obviously spending more time or working completely from home, so it's time to actually to enhance or build out that home office. So and I've had numerous conversations with people actually who are already thinking about the plans that they're going to do for their house. The 90 to 70% of us that still have jobs, fingers crossed, but that right. They are going to be looking at renovation, which kind of is a great segue. I know HomeBridge and Remen are leaders in their renovation products when it comes to the home style, and obviously 203K. You guys were like one of the leaders in that. I felt actually it's so much education. So that being said, the 203K is a perfect segue to talk about the premature rumors of government lending's death. So let's talk about that if you don't mind. There's a lot of people, and we do have a couple of questions, so please keep those questions coming in. I will go to those questions, but if you don't mind, talk to us a little bit about government lending and the future of it.
Okay, sure. Happy to do that. That was an interesting segue, though, because we have always been, if not number one, number two on the 203K side. I mean, we've always done a tremendous amount of rental business. We're fairly large with Fannie Home Style as well. I do anticipate that people, when this is all over, I mean, getting a contractor into your house right now is somewhat of a problem. So whether anybody would let a contractor in or a contractor is allowed to go into your house except for an emergency is somewhat questionable, but this will pass. This will all pass. At that point in time, when it does pass, I would anticipate that you'll see a fair amount of extensive renovation getting to people's homes because people just want to relax for a little while, be happy in their homes. Maybe they can get a job or have a job where they can work from home. And certainly if you're going to work from home, you want to work in a good environment. I'm fortunate enough, I'm actually in Florida right now and in my house in Florida. And I have a great work setup. I have video conferencing. I have everything I possibly need. You're looking at me in my office in Florida right now. And I think it's going to add to their overall renovation business. And we're looking forward to building on that as time goes on. There's no question. As far as government lending itself is concerned, we're a fairly large FHA VA lender. We always have been. It's been one of our mainstays, both on the wholesale and on the retail side. I don't see it going away at all. I think right now things are a little tighter, but that's more because of warehouse banks dictating to all of us what they will accept on their warehouse lines or what they won't. So we are going through that. There's no question about it. I understand one of the big warehouse lenders supposedly tomorrow, I got a advance notice of this, is actually going to say publicly, and they're one of the biggest in the country, that they're not going to allow any loans on a warehouse line with a FICO under 640. And they are one of the biggest lenders. Don't ask me who. I will not say a name on here because it's not fair. It's not fair to them. But I understand that is coming tomorrow. So there has been some tightening due to that, but I think most of this is cyclical, and I think most of it will pass. The bigger issue with FHA, VA, and VA lending right now is really more on the servicing side than it is on the origination side. But I think that exists even with the Fannie Mae, Freddie Mac paper as well. There are virtually, well, I'm not going to say there are no buyers, but if there were 25 buyers of servicing a month ago, servicing rights for any of these loans, there are 3 or 4 today. That's it. So they have had the ability to collapse the values of the servicing, or even zero, or even negative in certain instances, where you have to pay them to take the servicing. And that is problematic. I mean, it definitely is problematic for certainly people that are originating on a servicing release basis. And if the market shuts down for anybody to take servicing, it's very difficult, especially for the small to medium-sized players. The larger players can always retain all the servicing rights, especially if you're not pricing it, if you're not putting a value to it in your price, you can retain it. Like we're retaining everything right now after this month. We are still selling some servicing off. We have one buyer that is still buying some, but it's not the majority. It's a small piece of what we produce. The balance we are going to retain, and we will retain it for as long as we have to retain it. But our normal mix usually is 50 to 70% retained and either 30 to 50% released on a monthly basis. Now we're pretty much going to be closer to 100% going forward. So I think that's the bigger strain. I've heard people talking about that the FHA VA business is going to basically go away. I don't see that happening, but I do think that the deep credit FHA VA right now is going to be difficult. And as time goes by and we get through this crisis, and things normalize, I think you'll see things come back to normal fairly quickly. Starting to see signs of that already. I mean, I'm going to divert real quick. I mean, if you had jumbo loans that your investor reneged on as recently as a week ago, the bid on that paper to try and sell that paper was like 85 cents on the dollar. That has already jumped yesterday to as high as 95. So you're starting to get back into some normalcy slowly. I can't say it's going to stay that way. Certainly as the pandemic gets worse going into the middle of the month, because I think the expectation is this is going to be very ugly 2 weeks from now. And then hopefully we peak and it starts to go down, hopefully dramatically down. And as that happens, I think you'll really start to see things open up dramatically. But I do not believe FHA and VA business is dead at all. I think it's alive and kicking. I do not believe that the administration has any desire to get rid of it. Certainly it is key towards diversified lending. It is key for first-time home buyers. And it is certainly key to minorities as well, and people who may have a little bit of a credit struggle. So we want to make sure that we can keep on serving those customer bases going forward.
Yeah. So, and if you wouldn't mind, I'd love to talk a little bit about some of the servicing hiccups that that we're finding. I mean, because there's a lot of uncertainty, and a lot of it is caused through listen. We've got a great. We have a government that's listening to us, that's having dialogue. You're very active with the NBA, and they've been reactive to the conversations that you've been having, or the NBA has been having. But talk to us a little bit about the forbearance issue and how it's created a lot of uncertainty and kind of jitters amongst all the servicers out there.
It has caused more than jitters. I will say that. If you talk about stress level, I would say the big servicers are probably more stressed than anyone in this business right now, because certainly the government has made comments about things that they are going to do for the servicing community. The forbearance issue has not been made uniform yet. We don't really know exactly which direction it is going. None of us know that. We are supposedly getting guidelines from Fannie Mae and Freddie Mac imminently as to what can be and what can't be done. But one thing that everyone has to really understand, and this is really key, we cannot make the decision to put a loan in forbearance relative to Fannie Mae and Freddie Mac. The servicer cannot do that. Fannie Mae and Freddie Mac has to approve that. I believe FHA and VA have to do that. I'm not sure of that though. I'm not sure if the servicer is going to get the authority or not. And by the way, we use a sub-servicer. We don't service the loans directly. We actually use an outside third party. So the forbearance issue is a very big issue to all the servicers, because if payments aren't made, and a lot of people understand this, but a lot of people don't understand the fact that the servicer has to advance the principal and interest, the taxes and the insurance on every single loan, every single month, whether or not the borrower made a payment. We get that money back, but we don't get that money back until the borrower either catches up, or the loan is paid off, or the borrower is foreclosed on and we sell the property. So the potential for advances for every servicer out there are literally, in certain cases, in the billions of dollars, which private mortgage companies, and frankly, even the banks, don't really have the wherewithal to be able to make all of these advances. So what has the government done? The government did pass the $2 trillion stimulus package. That stimulus package specifically has a clause that has $450 billion that the Treasury can use to help institutions, and that it helped financial institutions. So, although they did not specify that it was specifically to be used as a servicing advance facility, the Treasury does have the authority and is working with numerous agencies, including the NBA, to get a fund established to help everyone, help every servicer lend them the money so that they can make the advances for P&I and T&I for Fannie Mae, Freddie Mac, and Ginnie Mae taxes and insurance. What has already been provided for on the Ginnie Mae side, which is what governs all government loans, FHA and VA loans, there is a facility that they do have an emergency facility that will allow them to lend to the seller servicers of Ginnie Mae loans, will allow them to lend to cover the advances for P&I and P&I only. That is actually moving pretty rapidly and should be in place, I'm told, within the next couple of weeks. Don't hold me to that one way or the other, but that will basically be a lending facility at a very low interest rate to the servicers so that they can cover that P&I on the Ginnie Mae advances. Assuming all that is done, we'll all be fine. But until it gets done, we're all going to be a very, very nervous community, to say the least. The bigger issue with the forbearance issue is really between the time we close a loan and the time that we deliver a loan. Because in that time frame, if someone closes and they lose their job the next day, that loan is not saleable to any of the agencies, which is a huge issue that we're discussing all over Washington right now as to how we're going to handle that. So the only thing I can say to every loan officer, every account exec out there, do not encourage people under any circumstance to close a loan and then go to forbearance right after. It is imperative that everybody makes their first payment at least, so that there is no issue whatsoever relative to the saleability of that loan. Because if all those loans did that out there, I can tell you pretty much everybody out there would be out of business. So it would crumble the mortgage banking community and the banks as well. So it's really imperative that these payments are made and that the loan officer community, the account exec community really understand how important this really is. I think actually Barry even talked about this on some other interview that I saw him in the last few days, maybe even with you actually.
Yeah, we just talked about that an hour ago when we did one. Yeah,
it's a big issue. Now, the other thing that Fannie and Freddie are coming out with, which is a mortgage payment deferral plan, as opposed to a forbearance. Because a forbearance, at the end of the period of the forbearance, which could be 3 months, could be 6 months, could be as much as 12 months, it's really vague as to how you're going to make those payments back. They're not being forgiven. And people have to understand that. A forbearance is not a forgiveness. It's a forbearance. It is, you have to make these payments. In certain cases, certain forbearance agreements require at the end of the forbearance period that you pay 100% of the payments that you didn't make back to make yourself current. In other cases, you can negotiate with the servicer and get approval from the agencies, both, and you can actually do a payment plan over the life of the loan. But one way or the other, you're making these payments. Fannie and Freddie are coming out with a payment deferral plan, which I think is really key, which I think is great. Basically, it defers the payments to the back end of the loan. So you will not, a customer will not have to pay it until they sell the home, and it'll come out of the proceeds of the sale, or they refinance at any point in time, and they refinance assuming the value of the house goes up and there's enough equity in it, they can refinance it and get a new loan and pay back that deferral. Or if the loan just fully amortizes over the life of the loan, although there aren't too many of those these days. But those three alternatives would happen to be a much cleaner circumstance for the borrower. And I actually do believe from a credit perspective, the borrowers would be in much better shape long-term under that scenario than a forbearance scenario. Because a forbearance, although it's not going to be reported on a credit report if it's COVID-19 related, and only if it's COVID-19 related, there still will be ramifications relative to refinancing if you go into a forbearance agreement at a future date.
So, and actually, that was just brought up by Lisa in the chat. She said, "Can you speak on the credit implications?" And so, like, so while it might not impact your credit score and might not be on the credit report, is it something that lenders could just have as another overlay that they could basically say, "Listen, if a forbearance exists." We will mark it against you. Is that what could potentially happen?
You know, I don't think it's really been defined, Andrew, at this point. It really hasn't been defined because this is an extraordinary circumstance. So I don't think we really know how a forbearance is really going to affect a credit report or not. I think the intent of the government is for it not to be reported to the credit bureaus, so the credit bureaus wouldn't actually see it. But if at some point in time they don't make up those payments, whether the requirement is at the end of 4 months, or the requirement is at the end of 6 months, or 9 months, or 12 months, or it's paid out over the life of the loan, if those payments are not met as required under the forbearance agreement, I can promise you it's going to show up on their credit report and kill them. So, which is why, unless you really are in trouble relative to you lost your job, you have no income, your income dropped precipitously due to a pay cut, I highly recommend that no one do a forbearance agreement unless you have to. But if you have to, you need to do it. I'm not telling people not to do it. If you're in trouble, you've got to do it. There's no question, because you've got to make sure you save enough money to have food and put it on the table for your family, because your family's got to come first. But if you don't need it, it's not the way to go. On the mortgage payment deferral plans, though, from what I understand, that will not show up on a credit report at all. So that is just pushing it all out to the back end of the loan. So as long as people are making their payments, there's not going to be an issue once that deferral is over.
Yeah, but again, you make your payments. Do everything you can to make your payments. You know, and tell your borrowers that they should be making their payments. These are, you know, these are options that are created as you know, worst case scenario. So got a couple of other you know, comments that have come in here. So someone's asking about non-QM. I know you guys are huge with non-QM, so if you don't mind, actually, I would love to actually get your you know, your feedback on, you know, so we went over that timeline. I should have actually asked the timeline with non-QM within that crazy March and February. So talk to us about, you know, where the non-QM you know, kind of started falling apart you know, during that timeline.
Sure, that's easy. We are a very large non-QM lender. I think we're one of the
Are, by the way, so everyone get that, not were, are.
No, take it back, Andrew. No, we were. We're not closing any non-QM loans at all. I mean, we are not. We can't. But that doesn't mean I don't think we'll be back in it. And I think we'll be back in it relatively soon. I don't think this is going to be that long a process to get back in. It may not look the same. I mean, it may be a lot tighter. But I do believe that the non-QM market will come back maybe pretty quickly. And I'll give you a specific example. So all the non-QM buyers basically pulled out when the liquidity in the mortgage-backed security market went away, and it really went away for government-backed mortgage-backed securities, but non-QM all of it goes into private label mortgage-backed securities, which is a whole different ballgame. So there's no government guarantee on those whatsoever on any of those loans that go into those securities. So that dried up really quick in the middle, really in the beginning of March. Certainly by the middle of March, it was over. So I think everyone pretty much cut off all their non-QM products. There were a couple of stragglers that held on maybe till the end of last week, but that was pretty much it. Because we do so much of it, we have one major investor that bought a large majority of our paper. And actually we have a fair amount of it still on our warehouse line, and they are buying it, and they have committed to buying it. And they will be buying it, I believe next week sometime. next week or the week after. It's a fairly large block, and they have not renegotiated the price of the term. But that's a big relationship, and that's why we're getting it done. But we can't add a single loan to it. So there's not like we can add anything. They know what we have, and they are going to fund it. On a conversation that we had the other day with a couple of my partners and myself with them specifically, they actually felt that the market was already changing and that they will be able to bring back a non-QM product within 30 days with very different parameters. Now, I'm not going to state one way or the other whether that 30 days is realistic. I personally don't think it is.
Yeah.
But they're really working on another product that they could put out. They have a lot of money. They have a couple of $1 billion in cash that they want to put out, and they think the market will actually get liquid again in a relatively short period of time. I hope it does. Certainly, I think once the economy opens up, whenever that is, whenever we start to open it up, which I personally think it'll probably be more like June 1st rather than May 1st, which I know the president would like it to be. Yeah. I think June 1st is probably more realistic for the country as a whole. But as that happens, I think you'll see a lot of these products reopen up again because there's still liquidity out there. I mean, there is, but the people that are getting hurt are the REITs that had margin calls, massive margin calls, similar to us. And, you know, so they had to liquidate all their private label securities at huge discounts. And that's what hurt them. So I think it will be back. I just think it'll look different than what we were used to over the last year and a half. Sure.
So what about, and someone was asking about this as far as down payment assistance programs. I don't know if you worked with down payment assistance programs, if they're just pretty much a non-option now. What are your comments on that?
I think it's going to be more of a function of the times that we're dealing with. I think they're going to be a hell of a lot more restrictive. The ones that are out there, I think some of them still do exist. The problem now is going to be with the warehouse banks as to what they're going to be willing to put on their lines. And I can tell you that the banks pretty much are starting to limit not only FICOs and putting minimum FICOs on it, they're also starting to put minimum LTVs. So the down payment assistance programs probably in the short run are going to be more difficult to lend from a warehouse perspective than they will be from a saleability point of view down the road. So again, I would anticipate that changing as well, probably by June. So, like I like to say to everybody in our organization, we have to be patient here. We've gone through a major upheaval. You've got the government basically shut everybody and everything down because they had to. Otherwise, millions and millions of people probably would pass away, which would be beyond tragic. And I think we all just have to be patient with where the market is. It will turn, it will change. I think people are going to be afraid to be in large groups for a long time until we actually get a vaccine. And once we have a vaccine, then we'll probably be back to normal. And hopefully that'll happen sometime this year. So yeah, that's sort of the way I look at it at this point.
Yeah. So and a couple of comments here. My buddy Paul Aceto. So Peter is saying payment deferral is better way to go versus forbearance. So yep, and our good buddy Carl Markman he commented here. How much do you admire the Redmond wholesale team and the fact that they have committed to same-day turn times on initial underwrites on purchase for 2 decades? It's crazy that you guys are still able to do same-day turn times, for initial underwrites on purchases. I mean, and I guess that's why you did, what was it, 1.9 or 1.8 in purchase, because
1.9 in total. 1.9 in total.
Okay, yeah, 1.9 in total. A lot of it actually is purchased because people know actually they can rely on Redmond when it's dealing with the purchases because like Redmond just sticks to that same day turn time. So truly phenomenal. So how do they maintain that? How do they maintain it in these insane times? And we did talk to Carl about this already, but I want to just get your perspective.
I blame that all on Noel Chapman. To tell you the truth. I think I think Noel has a pretty well greased machine. It has always been his philosophy to work under that, work under those parameters to make sure that the service level was there. It especially is important on the purchase side. I do come from a very heavy purchase background myself. Most of the businesses I've always had were always purchase oriented in everything that we did, because I've always been a firm believer that the purchase business is really your overall referral partner long term. Yeah. Refis are great when you need refis, and they're certainly, you know, great. They've been great really now. It's been what, 6 years, 7 years, it's been constant refis. But when you're a seller servicer and you're servicing loans, the refis aren't necessarily so great because it turns your portfolio. So the long-term outlook on a purchase is really, really the more important way to build a business long-term, in my opinion. That doesn't mean I don't like refis, so I don't want to take it that way at all. We do tons of refis, especially right now. Yeah. But we have to service our referral partners. The mortgage brokers who are dealing with REM and wholesale certainly know that they have to take care of their referral partners, whether it be realtors, financial planners, builders, whoever it might be, wherever the business is coming from. We have to perform. There's a contract date. It's got to close by X. And I think Noel and Carl are really into that and really understand that this is where your bread and butter is long term. And we have to make sure that we service the mortgage broker that's out there that's heavily in the purchase side of the business. Again, I don't mean to say that we're not going to service the people that are doing refinances also, because we will. But the purchase side, they're going to be there always. There's no question. The refis tend to come and go. On the government side, they don't come and go. They seem to come and go every 7 months, but because that's the restrictions. But you know, I think it speaks well for Carl and Noel and how they actually built the unit and everybody that works their tail off inside REM and wholesale, because they do, and I know they do.
And Carl just commented, "Thanks, Peter. You're an amazing leader." Which, you know, I've heard that before about you. So it's great. So listen, we're coming up on it's like right now 47 minutes into this. I know you've got to call in a little bit, so I want to be you know, a good steward of your time, and I appreciate, you know, you taking the time during this just chaotic time that we're experiencing in the industry. I know, actually, you know, during this, why this call's been going on, your inbox is filled up. I by the way, I see actually on the corner of your desk, your phone keeps lighting up. So you're getting calls, you're getting texts. People actually want to know, I haven't heard from you in the last 15 minutes. Is everything okay? You've got actually, I'm sure you've gotten reports, your hourly reports about, you know, where MBS is coming in. So thank you so much for taking the time, Peter.
Andrew, it's always a pleasure. It's always a pleasure talking to you, and anything I can do to help the industry and help my own company and help everybody involved, I'm happy to do it. I mean, okay. I do this for the people. So
if that's the case, what does it take to next time we have you on to get you to play actually a song for us live?
It'll take a lot more than our friendship. I can tell you that. It'll take a lot more, but you never know what I'll do. You know, anything's possible. Anything is possible at all. I need to practice more if I'm going to do something like that, but that's actually pretty funny. Did you record that, by the way? I just have a question. All right, Don, you know what? Don't even answer on this. There's too many people watching. Don't answer it. You know?
No one is going to hear that. No one is going to hear that. I promise. No one's going to see it. I did actually just realize that the Zoom does record actually automatically, but I promise you I'll delete it. No one will hear it or see it.
I think you're lying to me, but better
not. No, I'm not. But yeah, so, okay. By the way, if anyone wants footage, you know, please.
For a certain amount of money, you'll show it to anybody. I understand. I get it.
Never.
But it can't be used as a blackmail piece, okay?
All right. Listen, thank you so much. I know you are going through an unbelievable, stressful time, you know, and to be able to just kind of relax and share with us, you know, what's going on, and, you know, do it. We really, really appreciate it. So thank you again, Peter.
My pleasure. But I will also say tequila helps a lot. But with that, I will I'll sign off and say goodbye and thank you. I really appreciate it. All right. Take care, Andrew.
Fantastic. Everyone, thank you so much for watching. We got another one coming up tomorrow. Tomorrow is going to be David Stevens. Super excited to have him on. Obviously heavily involved, with the government, talking about actually, the policy changes as they're happening, and just we're blessed actually to have an administration that's listening to us and having dialogue, with the industry. And then following that up, we got some great actually interviews set up for next week. We're doing these every day at 4 o'clock. And we're going to keep doing them. At some point we'll, maybe slow these down, do them once or twice a week. But there's just so much information out there. Most importantly, we're hoping to do this to kind of share information with you. So you taking some of this information, sharing it with your community, sharing it with your employees, sharing it with your family, people who are trusting on you. The best thing to do out there is to be making phone calls, posting stuff on social media, and just showing that you're a leader. We will get through this. The other side of this is going to be very, very sweet. We'll all talk about that. As dark as it's going to get, the reemergence of the industry, of the economy, is going to be very, very sweet. So again, I'm Andrew Berman from National Mortgage Professional and Mortgage News Network. Thank you for watching.